Hi, welcome to Market in a Minute. This is where we analyze the markets, but most important, protect the downside when we think we need to. So, part of loss averse investing is getting there early and also not getting there too late. So, we've had a pretty significant decline, and we anticipated that, and we protected our portfolios very nicely this quarter. So last week we said we are going to talk about how we do hedging and our best biotechnology ideas. Unfortunately, there's more going on in the market, so we want to address that, and then we'll maybe do that next week. But we expected a 10% decline starting around the middle of July, and that's basically what we've gotten so far, real close to it. The question we have is how big is the yen carry trade? And the key thing to watch, in our opinion, is on what to do in the markets right now is the technicals. The technicals are breaking down, but they could reverse. So we're going to watch that closely. So our market outlook, we've expected the economy to begin weakening in the second half of this year for quite a while. So quite a while ago, we had this outlook because the size of the government spending was so large and all that money that was created, we thought it would just take a little bit longer for the recession to hit or a big slowing in the economy to occur. We think we're getting that now. So our view has been that the stock market measured by the S&P 500 was about 20% overvalued. Now interest rates have come down, but the concern now is looking at earnings. So as the economy slows, then the earnings become more questionable. So we don't know what the earnings actually are going to be next year. It's expected to grow nicely, but with the economy slowing so much, the markets put a cloud over that currently. So we thought we're going to get a nice rotation, which we got, followed by a correction in the overall markets. So we got the rotation, we're getting the correction. It could turn into a bear, we're not sure. So we'll have to watch it closely. So we thought the market would fall by 10% in the third quarter, starting around mid-July. And you can look over here at the chart. Sure enough, July 16th was the high, and we've fallen about 9% so far. So that's been our outlook prior to everything happening. So that's, in our opinion, a pretty darn good call. So what we did last week is we had a hedge in the portfolio already. We expanded our hedge to be a little bit more. So the tactical and loss averse strategies that we manage are only about between 14 and 18% exposed, so net exposure to the overall market if you count for the hedge. So we're pretty close to being locked down, and this little decline didn't hurt us very much, so we're very happy with that. So the big question we have in mind today is that yen carry trade. I'll talk a little bit more in detail about what that is, but we wonder how large that yen carry trade is, how much more we have to go on unwinding that, and then maybe there's another shoe to drop. Is there a financial institution or a large fund that may go under and cause some systemic issues in the overall stock market? So we're looking at the technicals. So over here, you can see we've gone through the 20-day, which is the red line, the 50-day, which is the green line, broke through the 100-day, and the 200-day is down around 5,000 on the S&P. So not too far away, but that's still, in percentage terms, a nice drop. So we're watching to see what happens. If the markets can bottom out here and then start to repair itself, maybe go back above the 100-day, we might get more interested in taking our hedges off and playing it on the long side. Or perhaps the market goes down, tests the 200-day, and we hope it does not break through the 200-day moving average. But if it does, our next buy point would be as it comes back through on the upside above the 200-day moving average. So in our opinion, the technicals are really important. There's some big questions in mind. How fast is the economy slowing? Right? That's one big question. And how big is this yen carry trade? Now we know the Federal Reserve highly likely is going to cut rates in September. We're already above where they thought the unemployment rate would go, so they're clearly going to have to cut rates in September. So last week we got this holy cow moment, and because my mother taught me well, I'm putting it in print. I said holy cow, okay? I don't like to have my mouth washed out with soap. So when the ISM Purchasing Managers Index hit on Thursday, it came out at 46.8. It was a holy cow moment. You know, that's not a good number. I always like to see the numbers when they're fresh, when they first come out, and see what my reaction to those numbers would be. And you can see the chart here. The ISM Purchasing Managers Index has been below 50 for a while. Just keep in mind, below 50, the manufacturing sector is contracting. Above 50, it's expanding. So down here around 42, you can see, actually the number's really 42 and a half, but around 42 and a half, the economy, the overall economy itself is likely in a recession at that point. So we're kind of approaching that level where it's a larger concern. But as you get down to that level, generally the markets have already pulled back significantly. So you don't want to have to wait until it gets to 42% before you do anything in your portfolio. But I find this a very good indicator in general. It's been negative for a while. The manufacturing sector has been struggling, and it's starting to get worse. So we're concerned of that. Oh, the components of the Purchasing Managers Index are very important. So the backlog of orders came in at a very dismal 41.7%. So orders are obviously new revenue growth, the orders that the companies are getting, and that's at a really low level. The employment as well at 43.4, that's at a low level. So not great news out of the cyclical part of the overall economy. You probably heard about the SOM rule. The SOM rule was invented by an economist. You know, there's another economist out there that I like that does a lot of work on this as well. It's Nancy Lazar. She's been pointing this out, that a number of states have seen their unemployment rate rise by over 0.5%. And therefore, you know, a number of states are probably likely already in a recession. The SOM rule states that the 3-month average, if it exceeds the 12-month low by 0.5%, then it triggers a recessionary signal. So I'm going to repeat that. The 3-month average of the unemployment rate, if it exceeds the 12-month low of the unemployment rate by 0.5%, it signals a recession. So as you can see, this is not the best graph in the world. So you can see that it's doing it. And so this is a long graph over a long period of time, and you know it's kind of distorted by what happened in 2020. But it is nicely above that 0.5%. That was tripped when the employment rate came out on Friday, came out at 4.3%. So that's up 80 basis points, 0.8% above the 12-month low on the unemployment rate. So, that's a problem. The dollar versus the yen. So this is the yen carry trade. So what investors do, or hedge funds, big institutions, they like to borrow money in yen, cheap rates, right? Really low interest rates, and then buy things outside of Japan. So as they do that, they may short the yen and then go buy stocks in the United States, like the Mag 7 or the Magnificent 7 or the mega cap stocks. So they may go and borrow yen, buy US dollar denominated assets. So that's a problem when this occurs. So we had an 11% drop in the dollar versus the yen. Let me explain that to you. So the dollar versus yen, if this chart is going up, right, that means the yen is weakening. So when it drops, that means the yen is falling. So the 11% drop in the yen is what they owe back. So that asset they borrowed is now worth less. So they lost money there. If the assets they invested in, like the Magnificent Seven or the S&P 500, went down in price, down 9% or more. Maybe a lot of those stocks are down more than 9%. They have a loss of over 20%. And if they're leveraged to it, say they're leveraged 10 to 1, right? If they're leveraged 10 to 1, they're bankrupt, right? So 20% drop down, 10 times that somebody might be out of business at this point if they were highly levered. You can see the Nikkei 225 down roughly 12% on Monday, our Sunday night, so down 12%. I looked at that at night on Sunday night, and I had another holy cow moment. So we're getting a lot of holy cows out there. So what's happening there as the yen goes up in value, their stock market does not like that, but it also helps offset inflation. So their central bank likes that a lot. So I think the central bank drew a line in the sand at 160. You can see on the chart 160 dollar to yen. They don't want it to go above that because it could really kick in a lot of inflation. So I think part of that was the central bank really pushing hard on getting the yen higher in price. So versus the dollar, dollar versus yen lower. So big drop in the stock market in the Nikkei 225. We're concerned about the spread of this. So, this potential currency crisis kind of turned the other direction, which is causing their stock markets to have problems. Could see something happen in China as well, that they might be affected by this as well. So our view of this is we've been cautious. We've gotten more cautious. We really like blue chip stocks a lot, income-oriented stocks, because rates are going to go down. Income-oriented assets, rates are going down, blue chips are going to do better. And then ultimately, the big trade is in small caps. That'll come. We want to get a little bit of a position there, but that will come. We're thinking over a couple year period that the small cap index could be up 50 to 100%. And if you're a good stock picker, we think you can make multiples of that as well. And then the real opportunity is in the biotechnology space. It's small cap biotechnology stocks look really compelling to us. But in the meantime, we want to respect the technicals, let the markets tell us when it's ready to go, see where it bottoms out. We're in an oversold condition, not significantly oversold, but oversold. So we might have a bounce here, but there's some problems that need to be resolved. And we didn't even mention what's going on in the Middle East, so that's another issue as well. So if you have any questions, come to my website, Patrick Adams CFA, send me an email, and sign up for Mark in a Minute. Get it a hard copy every week. But most importantly, subscribe to the YouTube channel. That's the best way of getting this information. Please hit like, and we'll talk to you next week.